Ladies and gentlemen, welcome to your favorite podcast. This is Real Estate Investor MBA.com. We created Real Estate Investor MBA to leverage the knowledge of giants through synthesizing and providing much needed information to all investors, from the veteran investor to the new and aspiring investor. At Real Estate Investor MBA, we plan to cover pertinent information head-on with our expert guests who we will interview on what they are doing and preparing for in the days and years ahead. We aim to create MBA quality curriculum topics and themes from the information garnered among our interviewed guests in order to bring world-class value to our fellow community of listeners. We truly believe that rising water raises all ships, and by sharing this leveraged knowledge, we can create a stronger online community, which translates to stronger local, regional, and national communities. Your hosts are Jeremy Moyer, who is a veteran real estate investor and author of a new book called Are You Playing the Real Estate Game Blind? As well as Tejas Gosai, the owner of eXp Realty, the Tejas Gosai team, and also co-manager in a newly formed Regulation D private equity fund called the Lehigh Valley Private Equity Fund. Now let's get to the show. All right, hey guys, we just finished our interview with Minal. Jeremy, what do you think?
It was dynamite. I love having her on. Tons of great info.
Yeah, she is a tax hacker. Her company is literally KB Tax Devisers, and they devise plans for their clients. Here's a little precursor. In this world, nothing is certain but death and taxes. We're going to see how this unfolds for our real estate industry. It's kind of scary.
A little bit. I was very subdued during the interview. I think because I was a little depressed.
It is. It's depressing is a good word. No one likes changes. New administration, Biden's here, really affecting our investors, our new investors that want to invest in properties and have considered 1031 exchanging in a couple years and things like that. It just changes everything. So it's kind of crazy, but great. We talk about it.
Absolutely. Everybody enjoy.
Take care. Ladies and gentlemen, welcome back to your favorite podcast. This is Real Estate Investor MBA. I'm here with my partner, Jeremy Moyer, co-host, and literally the czar behind our program. Jeremy, thanks for everything you do.
Absolutely.
We have wonderful guests. We've had almost 40 now. Episodes with a lot of heavy-hitting items, niche items specifically for real estate investing. And we have a lot of fun with our program. We always start with a thank you. We are all over the internet. We're on iTunes, Spotify, Stitcher, Podomatic, Google Play, iHeartRadio, and we love you guys. We're having some really big guests come on shortly. And we actually have our first returning guest who'll be on in a moment. But before Jeremy introduces her, let's talk about something big that's going on. Here's a quote from JFK. The tax on capital gains directly affects investment decisions. The mobility and flow of risk capital from static to more dynamic situations, the ease or difficulty experienced by new ventures in obtaining capital, and thereby the strength and potential for growth of our economy. And I thought it was super important to bring this up right now because we are under fire, is kind of the best thing I can say. A lot of folks that own real estate are going to have some difficulties with some of the administration and what is being proposed. And with that, Jeremy, let's have a good show. Bring on our guest.
Absolutely. So we are excited to announce our guest today. It's Minal Babaria. How are you doing, Minal?
I'm doing fantastic. Thank you so much for having me again.
Absolutely. No, we're excited to have you back on. So I think it's pretty cool that we're having our first repeat guest back on the show. So if anybody's interested in listening to her first interview, it's episode number 27. I've received a bunch of positive feedback personally just from other listeners regarding that. So there's some great information. So Minal is the president and founder of KB Tax Deviser CPAs, an industry-leading full-service tax and accounting advisory firm serving clients remotely throughout the United States. She specializes in serving small businesses' needs through customized, innovative tax strategies. So Minal, thanks again for your time this morning.
Thank you so much for the wonderful intro, Jeremy. And it's always a pleasure to join you and Tejas. I really love that quote, Tejas, by the way, on the capital gain. It's so valid, right?
Yeah, and Minal, while we're starting, I refer clients to Minal because there's a lot of ways through tax to eliminate or defer capital gains. And so this is a very, very, very strong topic for almost everyone in my network and a lot of people in Minal's network. Minal, you've recently helped some hoteliers save, I can't even say a couple $1,000, a couple $1 million recently. Can you just quickly tell us about that before we get into the rest of the interview?
Sure, that's a very good question, Tejas. And so my client, she is in California, planning to sell a hotel for $9.5 million. They have done 1031 exchanges already. So this is a third time, and they have to true up the bases. And they are at that stage in life with the COVID and everything. They don't want any more hotels. They're like, we are done. So, they approached us. We bounced back on multiple different strategies and stumbled upon one of that, which will keep all the options open for the reinvestment and wherever they want to do it, whether private equity fund or real estate, all of those. And this particular strategy is going to eliminate $3.3 million in capital gains taxes.
Wow.
That's $3.3 million.
More than they'll have in their pocket.
That's extra money. And I think that's the same money you can utilize to buy another real estate property.
It's amazing. and that's a specific tax strategy that Minal has had. You can contact Minal about that another time. But I want to stay on track. Minal, let's get into what we're talking about today.
Absolutely. Yeah.
So what's changing? What's going on right now? Tax rates? What just to kick things off?
Well, let's ask this way. What's not changing? Because pretty much every single tax rate or taxes are changing. Whether we are changing the tax rate or we are changing the dollar limits for the exemptions. So every single taxes that we have right now are impacted in a good way or a bad way, but it is impacted.
Yeah.
So that's just to give you, an idea. The Biden's tax plan is just a proposal so far. I know American Family Plan as well as the American Jobs Plan is kind of supporting it, but it's not an act yet and not signed into a law. But even if it gets signed into law, at least more than half of it will definitely pass through, whether we like it or not. And just because something hasn't happened in our lifetime, it doesn't mean that it can't happen, right?
Mm-hmm.
Absolutely.
So when do we expect the decision on the tax changes to go into effect? Later this year, next year? What does that look like?
That's kind of dependent on each different tax bracket or tax rate, what taxes we are talking about. But usually when this kind of new tax legislatives comes in place, it takes a longer period to narrow down the details before they enact it as a tax law. But with the COVID, we have witnessed that rush order processing on enacting so many COVID bills, and which seems like a recent trend, if we can say it that way. So the chances are that this could go into effect very quickly. Some of it might be effective January 1st, 2022. some of it could be effective retroactively this year. And if that happens, it leaves out very limited time for people to act on or do anything for tax planning, because that's too late. And our firm did a thorough research on last few years and the presidents that came in and, all the new tax bills that were passed. And we saw that the Omnibus Budget Reconciliation Act of 1993, even though that was signed August 10, 1993, that was made retroactively effective January 1st.
So let me get that straight, right? You're running your business, you're living your life, and it's August, and then this goes into place. And so you have to go back to January, right? And all of your tax, this is a nightmare for accountants doing taxes then as well.
It's more for the taxpayers than for us. It is a nightmare, but if you're not prepared ahead of time, then you have to be prepared to pay a huge bill at the end of the day, right?
Well, how do you deal with, if something's retroactive, you can't foresee what's going to happen. Is there, some predictive with what's going on with Biden? Could it be retroactive? Is there a chance for that?
There are chances for that.
It's terrible.
There are chances for that. And there were actually talks going on about the capital gains taxes as well, that, it could go retroactively starting from April of 2021 instead of starting January 22. So nothing has been finalized yet, but, we kind of recommend, if you're on the verge of selling a property or anything, and maybe you're thinking about next 2 years or 3 years or buying a property in next 2 years or 3 years, act a little bit sooner at this year. Because it could be way too late. And it's not about the sales price. The more important, how much at the end of the day is coming in your hands after sales and sales commission, all the selling cost and the taxes. Because the tax, the difference is huge. In our history, we never had capital gains tax rate matching with the individual tax filing tax rates, which is like 39.6%. Which is very high amount of taxes.
Can you explain that a little bit better? I'm going to pull up a slide that you sent.
Absolutely. So the whole reason the capital gain tax rates have been lesser in the past, because, government doesn't want you to pay the capital gain taxes at the highest individual tax rate. So as you see in this particular slide, in the past, highest capital gain tax rate was 20%. And we're talking about almost doubling it.
Wow.
Doubling it. And let's not forget, most states charge taxes from 3% to 13, 14%, which is in addition to what you see here. So if you were to sell a property, let's talk about maybe be ready to pay about 40 to 45% in taxes.
It's making me uncomfortable.
It is. And on top of that, there is a net investment income tax, which is Obamacare tax, which is 3.8%. So that's added on top of this 39.6% of capital gains tax rate. On top of that, you add state taxes. So you're we already got 44% here, 44 to 55% of the sales proceeds going in taxes. Right? Yeah. So, and for the smaller properties, it could be a little bit of a lesser impact, especially if you're doing 1031 exchanges and stuff like that.
Because, what do you mean by that? There's tiers for this new proposed?
Yeah, there are tiers to that. And the way these tiers work, up to $500,000 in capital gain taxes, you can do the 1031 exchanges. And you're deferring those taxes right now. And up to $500,000 in taxes, you can pay at your 39.6%. But then because your capital gain is higher, it pushes your whole income tax bracket to the higher level. So say, for example, if we exclude the capital gain taxes and someone is at 24% tax bracket, and now they got capital gain, because their capital gain tax is 39.6%, their income tax bracket is pushed forward, which will be, again, they will be taxed at 39.6% on all the income, which they should have otherwise be paying at 24%.
So it makes it less beneficial to sell the property, and then it also makes it less beneficial because you're going to be paying a higher tax for everything in your life.
Yeah, you will be paying higher taxes on everything pretty much. That's correct.
So do you think, what is the probability that this is going to go into effect?
It's very hard to say. People are fighting to not go this into effect, but
who's fighting? Who's fighting?
The Congress. I don't know if Congress will, pass this over, because it's a huge. I mean, we never had such a high capital gain taxes in the past. The way the economy of the country is set up, government wants people to invest more money in the country and buy more real estate, buy more investment and businesses and stuff like that. And to make it more lucrative, the way tax rates were set up, that if you are doing a long-term investment, you are paying lesser taxes versus doing a short-term investment. If short-term capital gain taxes are taxed at a highest individual tax rate bracket. And that was just to, make it more lucrative for people to invest money in the economy.
Oh yeah, no, it's the smartest thing the government could do. Hey, it makes it really beneficial to buy another property. That's what people do. And then you keep trading up. It's like baseball cards for some of the folks. I have 7 2 units and I'm going to go buy a 20 unit, and it works out really well. Actually, people that I've worked with for years, fun fact, one of my clients was telling me that in Long Island, growing up, he was taught cash flow and cap rates from the age of 12 years old when he was at Sunday school. And so they're bred to, understand what multifamily and commercial properties can do for you. But they have been 1031ing for generations now.
Wow.
And they've been deferring for, decades. So taking this element almost away, affects people that own that much, that many assets. It, really affects their whole entire portfolio completely. The moves that you've been looking to make 10, 15, 20 years ago, you're just not going to be able to make anymore, which is crazy.
And that's absolutely right. Actually, I speak to so many clients as well, Tejas, who wants to, sell the business or sell the hotel. And, we kind of do an analysis. I'm like, what would be the price if you were to sell it next year or the year after? And after you sell it, what is the remaining money in your hand after you pay all the taxes and everything? In my experience, most of those situations selling now have been much more, viable option, because even though if you're, on the sales price, it could be a little bit higher or low, but at the end of the day, you're keeping huge chunk of money in your own pocket. If the capital gain tax was about to go to double than what we are paying right now, it just makes more sense to do it now and invest that money, and you are generating extra cash for that invested money as well right now. The present value of cash is higher right now versus what it will be in 1 or 2 years.
So you're saying that because of all this, now's the time. It's the end of the second quarter. You have 2 quarters. You should 1031 now.
Yeah, absolutely. On the 1031 side, if the rule for the 1031 exchanges goes into effect, my gut feeling is it would be effective January 1st, 2022. It's not going to be effective this year. So we, what I recommend, if you have a huge property and you're expecting higher capital gain, more than $500,000 especially, doing 1031 now will be more beneficial, because under the new rules, 500 and above, you can't do the 1031 exchanges at all. You're disqualified.
I don't know about you, Tejas. I see a huge, if this goes into effect or even half of this goes into effect, I see a huge change in the real estate market with slowing activity.
Mm-hmm. Yeah, that's what we're afraid of. I guess temporarily, though, this is going to speed up activity.
Sure.
And I think it's important that we're having the show to indicate to people what's happening and how you can get through this. But yeah, Minal, you said something before we got on. You said this is like a fire sale emergency or something, where everyone's going to be going nuts for the next 6 months to try to do this. Can you talk about what the parameters are for a 1031, just for somebody who doesn't know the timeline?
The timeline for the 1031 is after the moment you sell your property. Before that, you have to decide you're planning to do the 1031 exchange. That's a number one key. And find the 1031 exchange, facilitator. Within 45 days of your closing, you have to identify the property you're planning to buy. And then I think it's 135 day. Within 135 day, you have to have that what we call transaction. I wouldn't say transaction finalized, but initiated, the sales agreement and stuff like that initiated. So overall, you have about 180 days on the 1031 exchanges.
Right, which means hopefully some of the people that are listening to this get in gear, because you have to do this pretty effectively and efficiently. A lot of my clients, I'm sure all of our clients, they identify way more properties than they may want to close on, and then pick one of them because they might lose one or market competition, things like that. Wild. It's wild.
It is wild. I was actually literally speaking to someone at 9:30, which is very unusual. I don't talk to my clients that late night. And this particular person is like, remember you told me about a strategy a few months ago? I have someone who needs to do 1031 exchange and his time is passing by, want to buy my hotel, and it's an $11 million deal. How fast can we set up everything? And he's like, he's running short of time and I'm losing my buyer.
Yeah.
So whether you are a buyer or you are a seller, either side, you have to be prepared, because when you get that buyer who is looking to buy your property and have this kind of a small window to meet, as a seller, you have to, first of all, have all your options laid out, because you can't just tell your potential buyer, I don't know what I'm going to do about my capital gain taxes. That's why I'm holding up on sale.
Mm-hmm.
I'll just, because I can say this, I literally had an hour-long discussion this morning with a client who has a very iconic property in downtown Easton. It's a couple $1 million. The previous buyer that it was under contract with was doing seller financing. The seller was very excited. She can take the money over time. The new buyer is doing a bank loan. And this is the conversation I'm having. She's like, I don't want to take it. Like, I don't want to take a $2 million offer that's a guaranteed closing with a very good buyer, because I don't want the money in, right now. And I hate capital gains. So like, this is just, so everybody's really specific on this, but it's very difficult to navigate, and it seems like it's only going to get more difficult.
But to add to that, Tejas, I had a very interesting conversation with one of the client, something similar situation, what you're saying. Let's say your client, they don't sell this property right now. They sit on it. 1 or 2 years from now, they will sell it. At that point, they will pay higher capital gains taxes. Now, just picturize it. If they had that money in their hands right now at a lower capital gain tax rate, in 2 years, the present value of cash will be higher than what it will be in 2 years after when they sell it, because they can invest this money in something else and earn even more money on it.
Right.
So people are not looking in that terms.
Yeah. Yeah, they need somebody to understand it or explain it. I mean, I'm still learning this.
We all are.
Yeah.
Even I'm learning something new every day on these taxes, and we find a new loophole every single day. So we all are learning together. But tax rates have gone up or low over the time. Life doesn't stop. We have to take the decision, which we need to. And if we don't act on it right now, I think 2 years of spending those sleepless night and searching on Mr. Google about the capital gain taxes, that itself adds lots of stress and health issues.
Yeah, you're right. It's crazy.
Outside of the tax the tax bracket changes with capital gains and the discussion regarding 1031s, are there any other proposed changes that affects real estate entrepreneurs specifically?
There are a few, especially I would say, I don't know if you know the QBI deductions, 1998 deduction, where you're investing in your own business. If it is a partnership, LLC, or S Corp, you get a certain percent of deduction on your personal 1040. The limits, dollar limits for those deductions have, real different rules for phasing out. So in the old rules, majority of the people were getting 1998 deduction. Now they will not get, many people will not qualify for those deductions. And that is right after your standard or itemized deductions on your 1040, the first page of your 1040. That's one. And on top of that, they are proposing having a net investment income or self-employment contribution act taxes, which is, so say for example, you are a partnership or an LLC, they will charge you taxes on your share of distributions above $400,000. So if your personal income exceeds $400,000, you pay taxes on that distribution. In the past, no partners, no S Corp, no LLCs paid these taxes. And now they are saying if it is an S Corp or a partnership or an LLC, you pay that extra taxes on it. So that's kind of a little bit of a tax issue, because in the past we all have taken distributions without worrying about it.
Mm-hmm.
Wonderful. We love having you on the program. I know you're doing some webinars, and I get your newsletters. You're very active in telling everybody what's going on. It's wonderful. How can anyone get a hold of you?
Absolutely. The best way to get hold of me is through our website, Get in Touch. The next thing we are doing right after the 4th of July weekend is we are having a webinar on tax independence. We are talking about the Independence Day and how can we minimize lifetime taxes with the use of the tax reduction planning. So if anyone wants to join in, get in touch from our website, and we will send you the webinar link as well. And I'm all on social media platforms: Facebook, LinkedIn, Instagram, YouTube. So feel free to connect with us on that side as well.
Great. Thank you so much. It's Real Estate Investor MBA. It's your favorite real estate podcast. We talk about some heavy hitting issues. Today's was definitely something that will rock the world of real estate. The more you know about this now, the better. So we love you guys. Please check us out next time, REIMBA.com. And we'll talk to you soon. Thanks again, Neil.
Thank you.
Thank you for having me, Tejas and Jeremy. Thank you.